We may be entering a new economic era where the prices we face every day are rising quicker than we're used to.
Inflation has surged to a 10-year high.
Inflation now at the highest level since 1982.
Sending already sky-high prices soaring even higher.
And economists are expecting an interest rate rise this year.
Fuel has never been more expensive. The cost of cars, building materials, and goods that have to be shipped around the country are soaring. Most of that inflation can be blamed on the pandemic, which has caused supply chain problems and severe labour shortages, at the same time as central banks have flooded their economies with cheap money.
Higher inflation wouldn't be such a bad thing if it's accompanied by higher wages growth. And that's something which has been absent for the last, 6 or 7 years. So that's been a bit of a downer for Australian households. If we start to see inflation being perpetually above, say, that 2 to 3% zone, say 4 or 5%, then that could start to become a bit of a problem.
For the last 40 years, prior to the pandemic, the growth in consumer prices had been getting weaker in the world's major economies. China had been exporting cheap goods around the world. Governments crushed union movements, and workers lost power to demand wage increases. And central banks used interest rates to push inflation down. In 1993, the Reserve Bank began targeting consumer prices to keep them growing within 2 to 3% a year. But inflation had fallen so low in recent years that the RBA regularly missed its target, despite cutting the cash rate to below 1%. But now the Reserve Bank's preferred measure of inflation is back within its target range, and there are concerns it could keep rising, causing problems for households. Not only are consumer prices going up, but so too could mortgage repayments, and Australians who have taken on a lot of debt could be financially squeezed unless wages start to rise too. Central banks in Norway, the UK, South Korea and New Zealand have already begun lifting rates to stop consumer prices spiralling out of control, and the United States is set to follow this year. So what about Australia?
Whichever way they go, though, there is no doubt that interest rates need to rise from here. I mean, we have got abnormally low interest rates. This is having distorting effects on asset prices. So the key is not if rates should rise, but when they'll rise.
As central banks remove stimulus from the global financial system, it's making share markets more volatile. Employers in Australia are already facing pressure to lift pay packets to ensure wages keep pace with rising prices. Otherwise, the purchasing power of workers will be declining.
The Reserve Bank has certainly taken a very strong position in recent years that it wants to see wage rises above 3% and sustained above 3%, and we're a long way from that at the moment.
So the Reserve Bank is facing a predicament. If it lifts interest rates prematurely, it could make it more expensive for employers to hire workers. But the RBA says its priority is getting as many people into work as possible and for wages to pick up, so it's willing to let inflation run for a while. But it doesn't want consumer prices to get out of control either. So it's going to be a balancing act and one of the stories of this year.